Hello friends, Namaskar. Welcome all of you to my channel. Today let's discuss about the one questions which I have taken from the corporate finance theory and practice from the Aswat Damodaran. You'll find in page number 633 to 640 friends. I tried to simplify the overall calculations and today's discussion would be important for all of you those who are studying in MBA, yeah, master level in commerce, yeah, even the professional examination like CA, ACCA and other examination friends. So first of all, in finance questions, particularly question related to valuations, we need to understand the question first of all because the questions might be so long. So our first job is to friends, so we need to organize the given informations. Particularly this question is all about imagine a leading biotechnology company was the rumored target of the takeover attempt in 1995. And although it has had a history of extraordinary growth and its growth is moderating for the two reasons. One is it is becoming a much larger company while its products are maturing and may face competition soon. It does not pay the dividend but some free cash flow to equity. This is all about your, we can say that free cash flow equity to equity is the matrix for the how much the that is the cash could be available for the equity holders of the company. This is all about the concept of free cash flow to equity. Okay, so this is all about so is that free cash flow to equity is likely to increase as the growth rate moderates and the firm gets larger. And finally leverage is stable. Leverage is stable, right? Then we are given other information is that okay, this is leverage is stable. And while we have information is that earning per share is in 1994 is 3.10 while revenue per share is 12.4. Capital expenditure in 1994 per share is $1 and while depreciation which is the non-cash expense is 0.6. While inputs for the high growth period, this case we are talking about the valuation of the firm using the two stage growth using the free cash flow to equity model friends in the context of corporate finance. Okay, so it's the inputs for the high growth period is that to overall length is for 5 years, return on equity is 18.78 and 100% we have a retention ratio which is noted by B here, and therefore we can say that growth rate would be B into R. That is the B we have a retention ratio, R is the return on equity. Okay, and that's why our overall expected growth rate is 18.78%. Now the beta during the high growth period is that 1.30. That's why our cost of capital, we can say that risk free rate which is given in the questions 1.3. This is the beta value which is the measure of systematic risks, and this is the risk premium which is given in the question. So we would have a 14.65 using the capital asset pricing model for high growth period. Okay, while capital expenditure, depreciation, revenues are expected to grow at the same rate as earning, that is the 18.78 percentage, whereas working capital is expected to be 10% of the revenue, and debt ratio is 18.01, and that's why our we can say that equity ratio could be 82%. Similarly, in case of inputs for this table, that is the growth is the expected growth rate is after 5 years is a 6%, and beta during the stable growth period is that we have a 1.10, and that's why our cost of equity could be 7.5 percentage plus beta value 5.5, just beta value change. That's why our cost of equity capital is now during the stable growth period is 13.55. But in this case, after 5 years, capital expenditure are assumed to be offset by depreciations, and working capital is same is expected to be 10% of the revenue, debt ratio remain the same. So this question is about what would be the value of the stock today of this company. So first of all, actually we are going to find the present value of the free cash flow to equity. Before that, we need to find this one. Capital expenditure minus depreciation 1 minus debt ratio. So this 1 minus debt is that as the equity percentage. So capital expenditure as per this question already given 1 and each year $1 per share, and each year there is increment is that 18.78 you can see here. Each year I just change it. While depreciation, which is the non-cash expenses, is $0.6 per share. So after 1 year its value will also increase by the same 18.78 percentage. Okay. Then what about the difference between the capital expenditure minus depreciation? Then simply what we did here, we can see here that is the this value minus this value. Okay, simply the difference between this minus this. Okay. So now what about the 1 minus debt ratio? If our debt ratio is 18%, so naturally our 1 minus debt ratio would be 0.82. That's 82%. So that's the capital expenditure minus depreciation minus 1 minus debt ratio is that this is the first calculation we need to find over the 5-year period. Now what about the second step, friends? This is all about calculation of the change in working capital into 1 minus debt ratio. So as for this question again, EPS already that's the revenue per share is that 14.4 is given. Yeah, this is $14.4. So that means each year again its increment is that 18.78, right? For 5 years, 6 years but after 5 years is the 6% growth rate. While working capital is 10% of this value revenue. Okay. So our concern is that what could be the our change in working capital. So this year change means, I would just show you, this year change means this year minus last year. So this is our change of first year, and accordingly we could find the change of working capital for respective other year too. Okay. Now what about the debt 1 minus debt ratio? We already know it. Now change in working capital minus 1 minus debt ratio is that we could simply say that, yeah, change in working capital into this. Okay. This way you could find your value. Now step 3 is that I just try to simplify it through step by step here, friends. Okay. So free cash flow to equity, which is simply the matrix of the how much the cash could be distributed to the equity holders of the company, equity shareholders. Okay. But during the high growth period, our EPS already given in the question, that is, this is now real framework I'm talking about. This is the EPS is 3.10. Okay. So 3.10 means each year our increment in the earning per share is 18.78. I move according to questions. But after 5 years, our growth rate is 6%. Okay. I'm talking about a stable growth rate here now. So capital expenditure minus depreciation 1 minus debt ratio, we already calculated step 1. We simply copy and paste here. Then what about the other case? Then again change in working capital 1 minus debt ratio, this is the step 2. So that is why the free cash flow to equity, simply we say that, friends, this is this value minus this value minus this value. We already calculated. Okay. So this is our free cash flow to equity. Each year I have calculated here up to 5 years. Now what about the present value? Yeah, discounted value of the free cash flow to equity. Then you need to understand this equation simply. That is the free cash flow to equity divided by 1 plus cost of equity capital whole to the power n. Like this case. This is our free cash flow to equity value, this one, C 48, yes, divided by 1 plus like our cost of equity capital during the growth period is at 14.65. So you are going to use that same value 1, and respectively I will do for the second, third, fourth, 5. So total sum of the present value of the free cash flow to equity during the high growth period would be $14.537, friends. So this is the main point that you need to understand here. You are going to find the what would be the free cash flow to equity present value during the high growth period. Okay, present value, discounted value. Then what would be the price of the stock at the end of high growth period? So this is simply, we say that this is called terminal price. So terminal price is that P5, which is noted by P5, expected free cash flow to equity. Expected, that means you can use just free cash flow to equity 6 R minus G. This is the constant growth model equation. Okay. So at first we need to find the free cash flow to equity for 6. Okay. So free cash flow to equity is that this one. This is expected. We find the cash. This is EPS 6. We know it. Yeah. This is simply EPS 5 into 1.06, while free cash flow to equity for 6 year is that EPS 6 minus change in working capital 1 minus debt ratio. So you need to understand here, friends, that is simply this value minus change in working capital 1 minus debt ratio. We already calculated this one. So EPS 6 minus, once you exclude this one, then that will provide you this one. This is the free cash flow to equity for the 6 year, and that is why our present value of the terminal price would be simply, we say that this value, yeah, this value divided by 1 plus K. But remember, friends, our cost of equity capital here is not the 14.65. During a stable period, our cost of equity capital is different, that is 13.55, because of your decreases in the beta value, which is the measure of systematic risk. So we have to use the here 13.55, you can see here, over the 5-year period. Okay. So the question is about, main question is that what would be the value of the stock today? So present value of the free cash flow to equity during the high growth period plus present value of the terminal price would be, now this is simply sum of what? Sum of what? Sum of present value of, this is you write the equation equal sign, this value, present value of free cash flow to equity during the high growth period plus present value of the terminal price. So our 68.038 is our, we see that present value of the stock to reference. Today we simply discuss about the questions which I have taken from the Asst.Prof. But in this book illustrations, mainly I found the changes in working capital differences, but answer might be different. But the way we solve the questions is that first of all we need to understand the questions. Then, friends, we need to organize the given informations, and accordingly we have to move accordingly step by steps. But point is that if we say that our value of the stock today of this company is the $68.038, and how we analyze is that if the market price is higher than this value, then we say that its stock is overvalued. At the same time, if it is market price is lower than that of this value, which is also known as called as a intrinsic value of the stock today. Okay, so this will be the underpriced, friends. So sometimes is from the valuation perspective we could use to value of our stock, friends. Okay, friends, I believe that whatever I discussed today, that would enrich your understanding level of your free cash flow to equity approach of valuation. Simply we discuss about the valuing the firm using the 2-stage growth, that is the free cash flow to equity model context of corporate finance. If you really like this content, please like, subscribe, and also share my channel, that is the Finance Guru, Pawan Kumar Jha. Thank you all of you for watching this video. Please take care all of you. Thank you.